From KUNC and the NPR network, this is In The NoCo. I'm Erin O'Toole. Some Colorado homeowners have a dilemma. Many people bought homes or refinanced during the pandemic when interest rates were at historic lows. Now they feel trapped by that low mortgage rate. They might want to sell and move, but can't afford to buy elsewhere with interest rates so high. The problem has been dubbed mortgage handcuffs. This dilemma isn't unique to Colorado, but it appears the problem is worse here than in any other state in the country, according to a recent article in the Denver Post. Libby Levinson-Katz is chair of the Denver Metro Association of Realtors Market Trends Committee and a realtor with Kentwood Real Estate out of Denver. She's here to help shed some light on the situation and where we might be headed. Libby, welcome to In The NoCo.
Thank you. Nice to be here.
I want to talk about how we got here. Just give us the backstory. What has led to homeowners feeling trapped in their mortgages?
It was historically low interest rates during the pandemic. That's very simplistic, but let me paint one picture for you. Let's just say it's April 2020. You're locked in your home. You're staring at your walls. And you realize that you're going to be stuck at home for a while. And there are many homeowners that fell out of love with their home very quickly and sold their house, maybe purchased a new house. Maybe they were a little rash and they decided, we need to be in the suburbs. I don't want to be in the city anymore. And they bought their house and they were really happy weathering the pandemic in their new house in the suburbs. And then they came 2 years later and realized, gosh, we really miss the city. We really don't necessarily love living in the suburbs. Maybe that was kind of a rash decision. And now they feel trapped in their house because they do have this historically low interest rate and maybe feel that they can't move back into the city because prices have continued to increase. And again, we have higher interest rates.
Right. And those higher interest rates can mean a difference of hundreds or thousands of dollars potentially in that monthly payment. So that's significant.
It really is.
Now, I imagine as a realtor, you've worked with at least one client who have found themselves in this situation. What was their experience?
Yeah, I've worked with quite a few. I have one in particular that they have been looking for 2 years. They're still looking, and they have a 2% interest rate. And even though their home no longer works for them, going from a 2% interest rate to, let's just say, a 7% interest rate, that's a big shock. And that is why we've been looking for 2 years, because if they're going to make that jump, the house really needs to be perfect. And of course, we know that there is no perfect home out there. And additionally, the market has slowed down a little bit within the last few months. And so on top of saying goodbye to a 2% interest rate and saying hello to a 7% interest rate, they were also competing against other buyers for homes that they, didn't necessarily feel were so perfect and weren't willing to compete against other buyers and overpay for the house on top of taking a higher interest rate.
So, Libby, the Denver Post article that I mentioned earlier mentions that the situation is worse here in Colorado than in other states. Why is that?
It could be for a number of different reasons. The article itself mentioned that people pulling out loans within the state of Colorado may have had the benefit of lower interest rates due to credit scores or down payment. And my thought on that is some of those purchasers may have also bought down their interest rate at the very beginning as well. So if they purchased a new home, they may have put down another $20,000, $30,000 upfront to try and get their interest rate lower than market value, which is a possibility. We call it buying down the rate. The other thing is in that 2020 timeframe when these low interest rates were happening, we have a lot of companies who have their corporate headquarters here. We also have a lot of tech jobs and a lot of medical jobs, all of which have a higher salary. So there are a number of different reasons. And that's my thought on why Colorado may have that larger gap.
Of course, we're talking about a problem that mainly affects potential home buyers and sellers, but is this having any sort of impact on renters?
There have been a lot of renters who are sitting on the fence since the pandemic happened. They may have not found themselves without a job, and the idea of renting something new was daunting, so they stayed put. And maybe they were looking at purchasing, but maybe they started dipping into their down payment just to get by during the pandemic. I know there were a lot of relief funds, but it was a hard time for everybody.
Indeed.
And then maybe they've been sitting on the fence and they're waiting for the market to crash. I hear that all the time. And frankly, the stats do not suggest that we're anywhere near a crash, especially because people have a record high of home equity. And so the renters are just sitting out there watching rental rates go up, property valuations are going up, which means rental rates are going up. Additionally, there are a lot of new rental buildings that are going up. So it's really affecting renters as well.
Well, Libby, I would love to put this into some historical context. Interest rates are high right now. They feel very high to many people, but they're not even close to what they have been in past decades. What does history tell us about what happens next?
Oh, that's a great question. We have certainly seen interest rates at significantly higher rates. I know my parents were telling me when they bought their house, it was 12%, 13%. But the prices of homes were substantially less. But really what history tells us is that interest rates are going to fluctuate. So while these seem very high, it's all relative. Yes, 7% is much higher than 3%. It's actually less than the historical average. The Fed has announced that they are planning to still lower interest rates at the end of the year. And so we're waiting and to see where that goes and what might happen. A lot of lenders have projected that we'll be in the low sixes next year. And so there is relief coming. It'll be interesting to see where that leads the real estate market and how buyers and sellers react to lower interest rates.
Okay, so if I'm in this situation, should I just resign myself to my mortgage handcuffs here, or is there something I should do to plan for the future of changing interest rates?
If somebody feels that they have handcuffs on, it would be prudent to talk with their lender to see what they can do, because the other thing is they're probably sitting on some really nice equity within their home. So taking some of that equity and moving that into your other home and putting more of a down payment. So for example, a lot of people consider 20% as being the gold standard. Well, what if you have enough equity that you have in your home that you've been living in for, let's just say 6 years, and then you refinanced during the pandemic? You're sitting on some really nice equity over those last 6 years and have a larger down payment. Maybe your down payment on the next house is more like a 30 to 40%, and it's helping to offset that payment. It's worth talking with not only a realtor to see what the valuation of your home may be in today's market, but also talking with a lender if you need financing for that next purchase to see what products might be available to you.
Libby Levinson-Katz, thank you so much for talking with me today.
Sure. Thank you for having me.
That's it for us today on In The NoCo. I'm Erin O'Toole. Thanks for listening. We'll see you tomorrow.